Ladies and gentlemen, good day and welcome to LTIMindtree Q4 FY24 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vinay Kalingara, Head Investor Relations, LTIMindtree. Thank you, and over to you, sir.
Thank you, Zico. Good day, everyone, and welcome to the LTIMindtree Q4 and FY24 earnings conference call. Today on the call, we have with us Mr. Debashish Chatterjee, Chief Executive Officer and Managing Director, Mr. Sudhir Chaturvedi, President Markets, Mr. Nachiket Deshpande, Chief Operating Officer, Mr. Vinit Teredesai, Chief Financial Officer, and Mr. Vipul Chandra, Chief Financial Officer Designate. We will begin with a brief overview of the company's Q4 and FY24 performance, after which we will open the floor for Q&A. During the call, we could make forward-looking statements. These statements consider the environment we see as of today and carry risks and uncertainties that could cause our actual results to differ materially from those expressed in today's call. We do not undertake to update any forward-looking statements made on this call. I now turn over the call to DC for his opening remarks. Over to you.
Thank you, Vinay. Good evening and good morning to everyone on the call. Thank you for joining us today. Before I begin, I'm pleased to welcome Vipul Chandra as our new Chief Financial Officer. His extensive experience will be invaluable in steering our financial strategy towards continued success. I also want to extend my deepest gratitude to Vinit Teredesai for his outstanding contributions during his tenure. His dedication and leadership have been instrumental in the company's growth and financial health. We wish him the best in his future endeavors. During FY24, the economic landscape was marked by unprecedented uncertainty and caution. Despite these challenges, we closed FY24 with a revenue of $4.3 billion, marking a 4.4% growth in US dollar terms. Our dedication to align closely with clients' needs is mirrored in the significant order inflow recorded this year. We achieved a Q4 order inflow of $1.4 billion and a total FY24 inflow of $5.6 billion, representing a 15.7% year-on-year growth. This demonstrates our ability to shift our portfolio from a relatively higher discretionary mix towards longer-term, efficiency-driven deals. We added 9 new Fortune 500 clients over the year, expanding our portfolio to 104. Additionally, in FY24, the $1 million plus client band has increased by 11 to 394 clients. The $5 million plus client band increased by 7, $10 million plus clients by 10, and our 20 million plus clients have increased by 2. Our disciplined execution helped offset the impact of discretionary spend slowdown, driving growth across all our verticals year on year. Our commitment to customer centricity is evidenced by our improved customer satisfaction score, which saw a 5-point increase from the previous year, surpassing industry averages. This quarter, we were honored to receive the Service Advocate of the Year award at the 3rd Annual Microsoft Supplier Prestige Awards. While our performance is in line with how the industry has performed, it falls short of our aspirations. A marked reduction in discretionary spend, where our portfolio has traditionally been skewed, resulted in a higher than anticipated impact on revenue. Additionally, some of our top 40 customers experienced a decline in growth due to market dynamics and client-centric factors. Despite these ongoing challenges, we have successfully capitalized on the emerging opportunities across verticals. Some of our recent key wins include, as part of a multi-year engagement, a leading financial services firm specializing in loans and mortgages has selected LTIMindtree as their primary engineering partner to meet their regulatory timelines and enable seamless operations of their application landscape through a remediation as a service and operations as a service engagement. A multinational financial services corporation has awarded LTIMindtree a multi-year contract as an exclusive assurance partner for their transformation journey by implementing a centralized quality engineering organization. A global leader in insurance brokerage services and risk management solutions has chosen LTIMindtree as their primary partner to establish a new technology platform as they create a new operating model in their digital transformation journey. A leading energy company in the Middle East has awarded LTIMindtree an end-to-end infrastructure managed services contract for 5 years. A leading producer of frozen products in Sweden has awarded LTIMindtree with a full scope infrastructure contract for cloud transformation. This is a new logo for LTIMindtree. Our focused efforts in expanding our capabilities and account mining have resulted in substantial growth in 3 service lines, of which 2 have shown double-digit growth. Let me cite a few examples to showcase our increasing penetration through cross-selling into our existing accounts. LTIMindtree has been chosen as the transformation partner to deploy S/4HANA solution for a global technology leader. This innovative software plus services engagement leverages our robust SAP capabilities. As a customer experience partner for an automotive solutions major, LTIMindtree delivered a mobile application with a revamped user experience and user journey, helping them move away from their current platform. For a US-based insurance and retirement major, LTIMindtree has been chosen as transformation partner to modernize their hybrid cloud operations with a converged operations model through Canvas AI ops-driven automation and GenAI solutions to deliver 70% improvement in issue resolution and service experience. In FY24, LTIMindtree enhanced its partnerships through various initiatives, including co-branding, co-marketing, and co-investments, focusing on key priority areas. Our joint venture with Aramco Digital is a notable example. This JV is a testament to our commitment to forge transformative partnerships. It broadens our geographical reach and opens new avenues for growth, particularly in the thriving Saudi Arabian market. The advent of GenAI and the potential it holds for transformative applications across industries is poised to revolutionize the way we approach problem solving, innovation, and productivity. Our strategic partnerships with industry giants like Microsoft, AWS, Oracle, Snowflake, and NVIDIA, coupled with our pioneering initiatives, including signing an MOU with Eurolife FFH to establish a first-of-a-kind GenAI and digital hub in Athens, and dedicated facilities in Poland and Mumbai, position us at the forefront of this revolution. We are proud of our commitment to service excellence, which has been acknowledged by some of the most reputable global partners in the industry. We secured the 2024 Google Partner of the Year title for the industry solution services for manufacturing. In addition, we were recognized as an Amazon Connect service delivery partner, highlighting our expertise in delivering top-notch customer service solutions. Beyond these accolades, our commitment to sustainability and social responsibility remains a cornerstone of our business philosophy, as demonstrated by our recognition in various awards for sustainability, DEI, and LGBTQ+ inclusion. Our success is attributable to the dedication, expertise, and innovation of our 81,000+ professionals. Their contributions have not only earned us recognition as a great place to work in multiple countries, but also laid the foundation for our future growth and innovation. Regarding our industry verticals, we have renamed some of them. However, it is important to note that there have been no changes in the client distribution or the financials. All growth numbers for both the verticals and the geographies are on a full year basis. Banking, financial services and insurance vertical declined by 2.8% on a quarter-over-quarter basis. This was primarily due to cancellation of 2 projects as clients reprioritized their spend. This also had an impact on the margins. However, on a yearly basis, our banking, financial services and insurance vertical grew 2.2%. Client priorities continue to revolve around regulatory commitment and data transformation for better reporting and decisions. The renamed Technology, Media and Communications business grew 1.7%. While our strategic clients continue to do well, this vertical had a higher component of discretionary spend, and that played out throughout the year. The manufacturing and resources business showed a strong growth of 14.6%. Demand was driven by ERP transformation, data estate modernization, supply chain modernization, and Industry 4.0 initiatives. Our retail, CPG, and travel transportation and hospitality business, now renamed as consumer business, grew 2.3%. Our health, life sciences, and public services business grew 6.1% year-over-year. In terms of geographies, for the full year, North America grew 5.9%, Europe grew 3.5%, and rest of the world declined by 3%. I will now turn over the call to Vinit for the financial highlights.
Thank you, Rishi. Hello, everyone, and thank you for joining the call. Let me take you through the financial highlights for the fourth quarter and financial year 2024, starting with the revenue numbers. We ended the fiscal year 2024 with a revenue of $4.3 billion, registering a growth of 4.4% in dollar terms. The corresponding constant currency growth was 4.2%. EBIT margins for FY24 was 15.7 compared to 16.2 in FY23. The absolute PAT for the full year was 4,585 crores, an increase of 4% over FY23, while the PAT margin was 12.9% compared to 13.3% in FY23. EPS for the full year was 154 rupees 90 paise compared to 149 rupees 10 paise in FY23. Cash generation for the year improved significantly in FY24, with operating cash flow to PAT at 123.7% compared to 70.2% in FY23. Free cash flow to PAT came in at 105.5% compared to 49% last year. Given our continuing focus on operating efficiency and working capital, we expect our cash generation to remain strong going ahead. For the fourth quarter of FY24, our revenue stood at $1.07 billion, up 1.1% year-on-year in USD terms. The corresponding constant currency growth was 1.2% year-on-year. Sequentially, revenue declined by 1.3% in dollar terms as well as in constant currency terms. EBIT margins for Q4 came in at 14.7% compared to 15.4% in the previous quarter. The key moving parts for the margin are 70 basis points tailwind from the partial reversal of furloughs, higher working days, and lower pass-through, offset by a headwind of 80 basis points from project cancellations. Higher SG&A and depreciation had a further impact of 60 basis points. Supported by our healthy cash reserves, we realized the returns of 189 crores from our treasury operations. The effective tax rate for the quarter was 24% compared to 24.3% in Q3 of FY24. PAT margin for the quarter was 12.4% as compared to 13% in Q3 of FY24. Basic EPS was 37 rupees 20 paise for the quarter as compared to 39 rupees 50 paise in Q3 of FY24. Through our steadfast collection efforts, we have achieved further progress in reducing our DSO. Our billed DSO further reduced to 57 days versus 62 days in Q3. We have made a significant progress and have brought down the total DSO by 11 days during FY24. In Q4, the total receivable days, including unbilled DSO, was at 80 days, an improvement of 5 days sequentially. We continue to progress towards our aspiration of reducing the total DSO to about 75 days. Our cash conversion metrics in Q4 continued to drive the strength of our balance sheet. The operating cash flow to PAT was at 158.4% as against 155.7% in the previous quarter and 88.5% in the same quarter a year ago. Free cash flow to PAT conversion held its strong trend and came in at 131.5% compared to 143.7% last quarter and 77.7% in the same quarter a year ago. We hope to continue with this momentum going forward. We closed the year with an all-time high cash and investment balance that stood at $1.38 billion or 11,525 crores compared to 10,116 crores in Q3 of FY24. Return on equity for the quarter was at 25%. As of March 31st, 2024, our cash flow hedges stood at $4,027 million and hedges on the balance sheet were $281 million. In our endeavor to build bench strength, we reduced our utilization excluding trainees to 86.9%. Our attrition continues to be stable. For the quarter, our TTM attrition was at 14.4% compared to 14.2% last quarter. We onboarded another 500 plus freshers this quarter. The Board of Directors has recommended a final dividend of rupees 45 per share subject to shareholders' approval, taking our overall dividend for the full financial year to 65 rupees per share. Our ESG strategy continues to propel positive impact on society through our ongoing initiatives. For example, LTIMindtree scored 10 out of 10 in the Travel Smart Campaign 2024's annual ranking worldwide. We are placed amongst the top 25 leading global companies striving to reduce travel-related emissions sustainably. LTIMindtree has been selected as one of the 320 organizations from over 46 countries listed as early adopters of the Task Force on Nature-related Financial Disclosure. LTIMindtree has scored an A- in the 2023 Climate Change Ranking by Carbon Disclosure Project. Out of the 23,000 plus global companies, we are in the 5% that have made it to the Global Leadership League. These awards affirm our commitment to creating a sustainable future for all our stakeholders. And finally, I want to express my deep gratitude to all of you for your unwavering support. It has been my utmost privilege to engage with all of you through the years. My best wishes to Vipul as he takes over as the CFO. I now hand it back to DC for the business outlook.
Thank you, Vinit. This quarter was a one-off. We will return to growth in Q1. The positive outcomes of our positioning as an organization with scale, expanded capabilities, and stronger partnerships continue to reflect in our order inflow and pipeline. Through the year, we have pivoted our portfolio to align with the current spend areas and are positioned well to capture the discretionary spend wave when it returns. We have entered FY25 with a stronger foundation to drive the revenue synergies. As we reflect on our achievements and look to the future, we are confident that the insights we have gained and the strategies we have implemented will enable us to execute better. We are excited to see what the future holds and committed to making the most of every opportunity that comes our way. With that, let me now open the floor for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Participants are requested to restrict their question to one and then a follow-up. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Nitin Padmanabhan from Investec. Please go ahead.
Yeah, hi, good evening. I had a couple of questions. So one is, how are you looking at the discretionary spend environment and the BFSI portfolio as we look out into next year? So that's the first one. The second is, how should we think about margins? Because even if I look at the current quarter, it looks like there are a couple of moving parts which need some context. One is that the employee costs have gone up on an absolute basis, despite headcount having come down. And there's also from a balance sheet perspective, looks like the right of use assets has gone up by almost 600 crores sequentially. So just wanted some context on both these things, along with the broader view on discretionary BFSI and margins. Thank you.
So as far as discretionary spend is concerned, at an overall level, I think there is still the same level of caution that we have seen in the last financial, and but at the same time, we feel that we are well positioned in terms of the portfolio that we have, the capabilities that we have in terms of bouncing back as and when the discretionary opens up. But the short answer is there is still caution as far as discretionary spend is concerned. 80% of our deals that we are, 80% of the pipeline that we have are still cost takeout, consolidation kind of opportunities. As far as BFSI specifically is concerned, again, it is continuing to be cautious owing to seasonal and macro uncertainties. There is a focus on regulatory and market compliance, and then those things can get into a long-term transformation as well. And as we called out, there is a one-time impact of 80 basis points this quarter due to two project cancellations where clients reprioritize the spends. In terms of margins, we had called out last quarter itself that we have to, change the, pause on the margin plan that we had, expansion plan. It does not mean that we don't want to get there. We still have a robust margin program in the organization, but given the fact that we did not see the revenue line coming the way we expected, we felt that it will not be appropriate to follow the margin plan because it will impact our growth. But all that I can say is that, over a period of time, we'll again get back to the same trajectory that we have, but it will take a while because we do feel that it's important to focus on the growth as well along with margin. But I just want to give you the assurance that the margin is of paramount importance, and we have a plan in terms of focusing on the margin, which we will see as we go along. And just to highlight one more thing is that as far as the margin program is concerned, this is kind of driven at the highest level in the organization. And in terms of the employee cost and the other question you had, I will request Vineet to answer.
Yeah, so Nitin, as far as the employee cost is concerned, there have been two factors to it. One is the fact that there is a little bit of an uptick on the on-site headcount, as a result of which there is a little bit of a higher cost. Secondly, this is also a little bit of a seasonal effect of some of the benefits getting aligned at the on-site level at the beginning of the calendar year. So these are the two factors. And third, we also need to remember, at the end of the day, while the net headcount is coming down, the replacement headcount that comes into the organization doesn't come at the same cost. So there is a little bit of an inflationary pressure that always comes in. So that's the three factors that are basically driving down the employee cost on the higher side.
Sure, perfect. That's very helpful. All the very best, Vineet, and thank you for all the support. and wishing you the very best, Vipul, in your new role. Thank you so much.
Thank you.
Thanks, Nitin.
Thank you. The next question is from the line of Sulabh Govila from Morgan Stanley. Please go ahead.
Yeah, hi. Thanks for the opportunity. My first question is on the deal wins. So this 3% YOY deal win number that we reported this quarter is a bit softer than a 20% growth that we've seen in the last 3 quarters. So is there a further change in the client behavior that you saw in this quarter, or is just a quarterly anomaly that will sort out over the next quarters? And if you could also comment on, given the divergence of deal wins and the revenue growth due to the changing nature of the deals that we are winning, at what growth levels do we think that of these deal wins do we think that there could be some meaningful sequential growth that we can report in revenue?
Need to take it.
Yeah. So coming to the order inflow point, Sulabh, if you look at it on a full year basis, right, to be touched $5.65 billion of order inflow, that's almost 16% up year on year. I think that's the better way to look at that number because this quarter, Q3 is the quarter of renewals. So that's why it tends to be the higher Y quarter because most of renewals happen in the October to December period. I think the overall order inflow, if you see, it reflects a good mix, as DC said, of our pivot to having a much higher share of the efficiency-led or cost takeout deals, which means that we have a more balanced, portfolio of revenues to look forward to from both a good mix of discretionary and, long-term efficiency-led revenues.
Understood. And at what point in time should we expect this divergence between deal wins and the revenue growth to sort out?
Yeah, I think it is as the deal wins ramp up, as you can see the years, the full year we've announced over, about 20 plus deals in the large deals space. And those, we are seeing them all ramp up by the new financial year. So Q1 onwards, we'll see that coming through.
Okay, understood. And my second question is with respect to the margin profile. I know you mentioned that the margin aspiration is sort of pushed out, and given the softer growth in the near term, that looks difficult. But I just wanted to understand that from a YOY perspective, the outlook for FY25 margins, could it be the case that they are similar or lower than F24 numbers, or do you think that is the number that you can maintain?
Go ahead, Vineet.
Yeah. So, look at it. Our aspirational margin of what we have laid down, both at the time of merger as well as in the short to medium term, that continues. As the business environment and the growth comes back into action, I think so the margin will also continue to see an improvement. Right now, for we don't want to comment anything on FY24 versus FY25. FY24 was a year whereby there was a 4.4% growth. And comparatively, obviously, with the initial startup impact of merger cost, etc., that were there, the margins had an impact. But as we get into FY25, it's a business as usual. The growth, etc., as it returns back, you will also see an improvement in margins coming back. I just want to reiterate the fact the 17 to 18% target still remains the same. And our overall aspirational target, what we had laid down at the time of merger, also remains intact.
Understood. Thanks for taking my question.
Thank you. The next question is from the line of Manik Taneja from Axis Capital. Please go ahead.
Hi, thank you for the opportunity. Just wanted to get your thoughts around the...
Sir. So your voice is not audible, so may I request you to use
your hand,
better? Please?
I hope this is better.
Yes, sir. Please go ahead. Thank you.
Just trying to prod you further on the financial services vertical performance through the course of FY24. what we've seen is that our revenues has come off through every single quarter, while in the current quarter you highlighted the impact of two certain projects. But how should we be thinking about this particular vertical on a go-forward basis? Because in the past you have talked about certain consolidation deal wins in the industry, and which should probably be helping your cause. That's question number one. The second question was with regards to the high-tech vertical. How should we be thinking about the fact that our top client performance has extremely been good through the course of FY24, while we've had challenges at a industry level? Thank you.
So, Manik, as far as BFSI is concerned, we did have a one-time impact of due to two project cancellations where clients reprioritize their spends, and because it is one-off, there is nothing for us to believe that we don't get back into growth as we get into the Q1. As far as your high tech is concerned, I don't think the top line continues to grow as we have seen, and there is enough opportunities to leverage the expertise that we get with the top client and take it to the other other clients, and that is something which is going on. And with that, we should be able to channelize the growth in high tech as well. So I don't think there is any reason for us to get worried about those two areas.
DC, my question was with regards to financial services through the course of the year. I do understand that this quarter essentially we had certain project cancellations, but financial services has been weak through the course of FY24 every single quarter, and we have been talking about deal wins and consolidation wins for us, and that's the reason to simply check with you on how should we be thinking about financial services growth.
So I think I misunderstood your question. If you look at the financial services per se for the full FY24, we have actually grown at 2.2%. So from an overall full year perspective, it has been a growth story for BFSI. And barring the impact that I talked about in Q4, I don't think there is any reason for us to believe that there is any specific softness. In fact, there is a lot of work that we do in the regulatory space, which still continues. Yes, discretionary spend is not yet back, but as and when it is back, it will only help us and benefit us in the long run.
Sure. And just wanted to get your thoughts around some of the leadership exits that we've seen in the company through the course of recent months. There was an indication that the organization was beginning to stabilize post the merger, but we've seen an increase in terms of recent exits. So how should one be reading this? Thank you.
Well, I think, the merger is pretty much behind us. As of 1st of April last year, it is LTIMindtree, and in any organization you have exits as part of BAU. So I don't think we should read beyond that. And please understand that when these two companies came together, we had significant leadership bandwidth. So essentially, in spite of whatever exit you have seen, we have been able to grow year-on-year basis, and there is a strong team on the ground, and we are very confident in terms of our future as well. So I don't think we should attribute this exit to anything other than normal BAU, and we are well geared to deal with any of these changes.
Thank you, and wish you all the best for FY25, and wish both people and we the best in their respective endeavors.
Thank you. Our next question is from the line of Ravi Menon from Macquarie. Please go ahead.
Hi, thank you for the opportunity. If we look at LTI pre-merger, used to have a seasonality in Q3 in manufacturing, and we had thought as a combined company the seasonality should reduce. But this quarter it looks like that's actually magnified. Could you explain a bit what happened in manufacturing this quarter?
Well, as far as manufacturing is concerned, the seasonality that you saw in the last quarter, and that continues. That is not, there was a significant amount of pass-through, which was there in Q3, which was not there in Q4, and that is part of the manufacturing. So beyond that, I don't think there is any other factor.
Thank you. And this quarter also
and by the way, I mean, just on a full year basis, if you again go to the FY23 to FY24, manufacturing has grown almost 15% year on year.
Thank you. This quarter, when we look at the growth across client tiers, except for the top 5, it looks like there has been a decline in the top 6 to 10, top 11 to 20, and beyond that as well. So is there a broad-based slowdown still happening? Are there are clients still cutting back on projects, or do you think we are the fag end of this?
No, I think if I understood your question correctly, when you talk about the, some of the pass-throughs that we had, that is kind of impacting the, some of the clients in the 1 to 40 segment as well. But what you need to understand is that the top 40 has grown slightly higher than the overall company average for the full year. And we have pretty much seen growth across all the, most of the 40 clients, top clients on a year-on-year basis. So I don't think, there is any change to the strategy that we had, and the strategy has worked out fairly well.
I just follow up on that. This pass-through should have been for a very specific client, or perhaps 2 clients at most, right? Because this is a seasonal thing, and we have that every Q3 with probably an Indian manufacturing client. But this is a slowdown that we see beyond that as well. Each segment, when we look at it individually, top 6 to 10 or top 11 to 20, and beyond that, we're seeing a QOQ decline this quarter. So that's why I was wondering.
So I think there are 2 things. One is the pass-through is, probably a few more clients rather than just 1 client. That's number 1. And number 2 is that I don't think we should look at quarter on quarter. We should look at the overall year on year. And if you see the year on year data, it is looking pretty positive for us.
Thank you.
Thank you. The next question is from the line of Vibhor Singhal from Nuvama Equities. Please go ahead.
Yeah, hi. Thanks for taking my question. 2 questions from my side. One question, DC, just wanted to check, as you rightly mentioned, our top clients have actually grown higher than the company average, and that's true for FY24 as well as the last 4 quarters as well. So just wanted to pick it the other way around. I mean, the growth has actually been dragged by the long tail, or let's say the remaining part of the client bucket. So what is it that we are seeing there which is kind of making this revenue overall drag than the top 40? I mean, I'm imagining that the top 40 clients' performance would have been impacted by the project cancellations you mentioned in Q4. But despite that, the non-top 40 clients, apart from, let's say, the discretionary spend that you mentioned, any other thing that you believe is impacting them? And do you see some of them reversing in the coming quarters? And then I have a follow-up for the lead.
So Vibhor, as I said, I mean, if you look at the, I don't want to kind of focus on quarter, but if I look at the overall full year picture, if I look at the year-on-year FY23 vis-a-vis FY24, the top client, the revenue contribution has actually, increased slightly compared to last year, compared to FY23. So I think our strategy of, account mining and focusing on the top clients and, focusing in terms of cross-sell, upsell, I think that is working out fairly well. Now, obviously, the macro conditions did not allow us to do anything more than what we could have done, but our strategy is pretty much in place, and we will continue with that strategy. And along with that strategy, if there is an opportunity for us to do a tail rationalization at some point of time, we will also do that. And the client base has also expanded. Each client base has also expanded. Each vertical has also grown. So let's look at those things aspect. I will let Sudhir also add on.
Yeah, just one point in terms of the program that we've been running in the company, the Focus 100 program that we've talked about. So, we've gradually rolled out that program. We began, as you can imagine, with the top 50 accounts. That was our first priority. Now we rolled it across the 100. And now as we have experience of rolling out the program, we will also now bring in the rest of the clients that we have, especially the $1 million plus clients. I think we have 394 clients that are above $1 million. So we will use the best practices learned from this rollout to cover the rest of the accounts as well.
Got it. Thank you so much, DC and Sudhir. I just have one follow-up question for Vineet. So Vineet, I think on the margins front, of course, this quarter you mentioned the impact of things and all. But first of all, are we looking? I mean, what is the fresher hiring target that we have for FY25? And do you believe that could actually impact margins basically negatively in the near term? Taking that into account, and given that utilization is already 87%, what could be the incremental margin levers for you from current levels?
See, there is a senior level margin improvement program that is being launched with multiple aspects of it, and freshers is only a part of the strategy. As we have stated in the past, our pyramid rationalization, adding more people to the bottom level is something which we are doing. Secondly, in the current context, we are also working out on the right role, right pricing and the red programs whereby the margin needs to be improved over a period of time. All those things are working on, and at this point of time, those are going to be our levers to which we'll focus on. The third important aspect is growth. At the end of the day, the growth will drive down the margins. We have well placed. I don't think so we need to make that much amount of investment on our SG&A. Our SG&A is much more stronger to bring, to sort of support a larger growth that will be coming in. And that's how I will leave it at this point of time.
Got it. Thank you. Thanks a lot for taking my questions, and wish you all the best for your future endeavors.
Thank you.
Thanks a lot.
Thank you. The next question is from the line of Kawaljeet Saluja from Kotak Securities. Please go ahead.
Yeah, hi. DC, my first question is for you. See, it does not look like, in FY25, your discretionary spending outlook would improve. So with that being the case, should your growth be similar to what you saw in FY24? Or are there any specific interventions that you have made in terms of cost takeout, deal participation, etc., which could change your growth outlook for FY25, even in a challenging environment?
Yeah, hi, Kawaljeet. So, Kawaljeet, as far as the, growth is concerned, I think the one thing which has happened in FY23 is the deal profiles have changed significantly from a discretionary to more of cost takeout. And typically what happens in this cost takeout deals, they are multi-year and, initially for the first couple of quarters, there is always some transition involved, etc. So the revenues normally kick in when you have kind of ramped up fully in those deals. So there are quite a few deals in which we have completed the ramp up. Some of the ramp ups were actually delayed as well. But, the confidence that we have in terms of, as I said in my opening remarks, that this was a one-off quarter and we will get back to growth. That confidence comes from the fact that many of those deals have kind of ramped up and the revenues should kick in. Now, if you look at the pipeline that we have, 80% of the deals in the pipeline are also very similar nature deals. So which means that they need to be closed, they will have transition, and then the revenues will ramp up. So the big positive is that there is a much more stickiness in terms of revenues as we go along. So the discretionary situation has not changed significantly, and I don't think we can say that the discretionary situation is any different at this point of time, but it cannot be remaining forever. But we are well prepared to adapt to the scenario where discretionary spend comes back, and we should be able to leverage that as well. So that gives us the confidence of growth. But at this point of time, I'm not going to get into a comparison of growth, but definitely, we are on the right trajectory as a team.
Okay, that's helpful perspective, DC. The second question that I had is for Vineet. Vineet, this one-time impact of 80 basis points due to project cancellation, how does this, play out? Was there a revenue reversal or, was there basically transition costs that you were carrying which have written off? How did it show up in the P&L?
Basically, the project cancellation, we basically had anticipated that this revenue to sort of come in. And against that, we had done the ramp up and location of people, which didn't translate it till almost at the end of the quarter. And that's the result of it. The impact on the P&L was felt, but the revenue and P&L was felt through the revenue not coming in, but the cost continuing and the margins sort of getting impacted.
Okay.
But now these people have been sort of redeployed to the other projects, and as a result of that, in Q1 you should see a good amount of this returning back.
So when you show the utilization number, it's adjusted for this, or the utilization is on a gross basis, which is including the project cancellation resources, the resources which were used on programs which got eventually cancelled.
Yeah, but see, as I said, that till the fag end they were allocated. So for us, they were into that billable position. So for us, they were considered to be unutilization. We are not sort of adjusted the impact of that.
Okay.
You want to add?
And Kaljit, I'll just add one point, Nachiket here. There is also, these were sort of a software plus services type of project. So there was some license write-off that was also involved. It was not just the headcount related part. So you see that in both hence in the revenue and the margin.
Okay. That's helpful. The third question and the final question that I had, Vineet, is on your hedges and forex income. Now, logically the rupee has been stable. So rupee is stable. Normally you end up booking your forward premium. Effectively, you end up realizing that into your P&L. But when I look at FX income for FY24, actually there was a forex loss, which seemed to be a little bit unusual, because even now when you sell contracts in the forward market, you do get a premium on a 1 year, 2 year, 3 year basis. So what contributed to that forex loss when you look at FY24, or other negligible profit forex gain as such? And should this number start normalizing as we move into the next year?
See, forex, the hedges what we have and the impact what you see, these hedges have been taken over a period of time in the last 2 to 3 years. We effectively run almost 3 to 5 years forward-looking hedging program. So these hedges have been taken at different points of time. Secondly, while the forex from an average monthly perspective sort of doesn't show that much amount of volatility, the hedges get settled towards the fag end of the month, whereby there is a volatility, and that's where the sort of impact of the losses come in. The third, hedging strategy is always supposed to balance out and not necessarily reflect on our P&L as a gain or loss. We look at it as a balancing approach, whereby on the one hand we get a benefit of a volatility on the rupee till EBIT level, and that gets offset by the hedges that we take cover. If that happens in synchronization, you will see absolutely a zero impact on the P&L. But as I said, since the hedges, the cost gets incurred on an average throughout the quarter, but the hedges get settled towards the fag end of the quarter, and that's where the difference comes into play.
Vineet, what is the realization you're carrying for FY25 book of forward contracts?
That's there in our OCI. You would see it's reflected.
That will be for a 3-year period, right? $4 billion.
Yeah. So I won't specifically comment on it because the hedges what we have today, plus we will be taking over a period of time depending upon how the forex moment happens.
Okay, fantastic. Thanks a lot, Vineet, and all the best in your new endeavor. Learn plenty from you here.
Thank you.
Thank you. The next question is from the line of Dipesh Mehta from MK Global. Please go ahead.
Yeah, thanks for the opportunity. Couple of questions. First, about the wages.
May I request you to use your handset, sir? Your audio is slightly muffled, sir.
Is it better now?
Yes, sir, this is better. Thank you.
Yeah, just want to get sense about the wage hike cycle. If you can help us understand by when do we plan to give salary hike in this year. Second question is about utilization. What would be our comfort range in terms of utilization? We are currently closer to 87%. So if you can give some sense about it, because our headcount is continue to taper off, but we are expecting now growth trajectory to start from Q1 onwards. So if you can just help us understand how one should look at it. And last question is about rest of world. Now, one can understand about US, Europe, some kind of macro challenges impacting the performance. But for us, the rest of world, even if I look from full year perspective, seems to be weak. So if you can provide some comment around it. Thanks.
Okay, I'll let Nachiket start and then I'll chime in as required.
So on the utilization front, I think as we've said, 85 to 86% is our comfort zone, balancing sort of a growth and the efficiency ambitions. So we're right now slightly higher than our comfort level. So as we see the growth coming up, we talked about Q1, you will see us that will probably end up taking utilization down by 50 to 100 basis points. As far as our salary revision part is concerned, I think during the year we do that on the basis of the competitiveness that we see in the marketplace, the individual performance, and of course tenure of people in the company. Even this year we'll go ahead with a similar approach in terms of how we roll out increments. The timing of that is we're still in the planning process to decide bonus. But at the same time, we are on track to pay our bonuses. We do half-yearly bonus payout. We paid the first half on track, and we are on track to pay the remaining part of the bonuses also after the results.
And in your, as far as your question on ROW is concerned, the decline that you see in ROW is the only reason is there was a significant pass-through that we had in Q3. And, that is the only reason why we had a decline. But otherwise, we are still confident that, the growth that we will be seeing should be broad-based as we go along across geographies as well as verticals.
This I was referring from fiscal 24 perspective, not for Q4 perspective.
Yeah, that's right. I mean, we are, the degrowth that you see in terms of ROW is primarily because of a significant pass-through that we had in Q3. And, some impact in Middle East as well in terms of some specific, I think it is linked to the same BFS that we are talking about.
Okay, thank you.
Thank you. The next question is from the line of Mohit Jain from Anand Rathi. Please go ahead.
Hi, sir. 3 questions. One is on TCV. So if I adjust for that BFSI deal cancellation that you spoke about, our TCV growth for FY24, is it still 15% or should we look at it, say, 14% or 13%? That's the first question. And the second is on CapEx. Like our CapEx is still high, while for the whole year employee addition is not there. So what should we expect there in FY25? And third is on BFSI decline. Like, can you share services growth in this segment for the quarter? Because last time you spoke about very high pass-through component in BFSI.
So do you want to take the TCV?
Okay, so on the TCV point, so the number we reported is net of the cancellations that DC spoke about. I'll just cover. Sorry, your BFSI question. Do you mind repeating it?
So last quarter you spoke about a significant pass-through portion in the BFSI segment revenue. Is it true now that the revenue number that I'm looking at 4Q FY24 BFSI segment? Is it services? What would be the services growth number for Q4 on a sequential basis?
No, okay. So I think I'll ask Vineet also to add to this, but I don't believe there was a significant pass-through in BFSI in Q3. These 2 cancellations are primarily services. There's some other, some license elements, but it's primarily services.
So Mohit, I don't think so we ever said that there was a pass-through component in the BFSI per se alone. What we said was last quarter we had a significant portion of pass-through and that was spread across all the verticals, including BFSI. But it's not that the BFSI was driving down the significant portion of pass-through. It was in the manufacturing sector as earlier called out.
Manufacturing, sir, I'm aware of. So BFSI growth, whatever you have reported, that is the services growth for the quarter as well.
That's right.
Absolutely.
That's great.
Okay. And the last one was on CapEx. Like CapEx is still high for the year versus employee addition. So how should we look at it from an FY25 standpoint?
See, after the pandemic breakout, we have seen that the first 2 years we had not spent on CapEx. As now we are asking people to partially return back to office. We had to create capacity because now we have people spread across multiple cities. So on an overall note, there is enough capacity. In each individual cities, there is a deficit in certain cities, which we are sort of building out. I think so for the next year to 2 years, you should anticipate that the CapEx will be on a higher side because we are building that CapEx from a forward-looking perspective, at the same time also to bridge this deficit whichever is there. On the other hand, you should also keep in mind that as we build some of these CapEx, there are certain leads cost also that will start up coming down as we start up surrender some of these leases. So we have to look at that from a net perspective.
So the number you report in the cash flow statement, that is net only, right? Or will it be gross CapEx number?
It's a gross CapEx number. That's what I said. We will incur CapEx in the next year and a half till we sort of build up the capacity and bridge that deficit that we have in certain cities.
Okay. Got it, sir. Thank you.
Thank you. Our next question is from the line of Sandeep Shah from Equirus Securities. Please go ahead.
Yeah, thanks for the opportunity. DC, in your opening remarks, you also alluded that apart from macro issue, there were some client-specific issue in the top 40 clients. So how many such clients you have faced the client-specific issue, and most of them are largely behind, or you still witness entering FY25, especially if you can speak about the top client in the BFSI?
Yeah. So I think the only thing we called out is, the two clients which we talked about, or the two projects, I would say, not client, two projects in BFSI which had, the impact in terms of revenues reducing in BFSI. And apart from that, I can only say that some of the discretionary spend in the clients have declined, which we have been talking about for a while. The macro environment has not been the most conducive in terms of clients to get back on discretionary. And there has been also some insourcing that we have seen in the top 40 clients. In spite of all these things, we still at an overall year-on-year basis, if I just look at FY23 and FY24, the top 40 clients still grew 4.5%, and which is in line with the overall organization growth. So overall, I think we are in a good place. In spite of so much of so many challenges, we still have managed to grow the top clients the way we wanted, and we are well positioned in terms of further growth as and when the discretionary comes back.
And just further to that, any outlook in terms of growth expectation from a top client in BFSI in FY25?
Yeah, I'll let Sudhir.
So I think Sandeep will talk more about the overall at the overall BFSI level. So as DC mentioned, we've been announcing deals at BFSI. In fact, even in this quarter, we have two large deals in the BFSI space. So, and it's a good combination of cost reduction deals plus some core transformation deals, especially in the payments, platform transformation space or the lending platform transformation space. And we have a good pipeline in the existing accounts. We had a good new logo addition also that happened this quarter in BFSI. And, as I said, the large deal pipeline in BFSI continues to be strong. So I think overall BFSI, if I were to look at it from Q1 onwards, we should start to see a good return to growth. Reflective of the work that has been done or the order intake that has been done in FY24 and what we are seeing currently in the pipeline.
Okay. And just last few things, just clarity on this 80 bits impact on the overall revenue because of project cancellation. Is it the revenue being reversed which were booked in the quarters before fourth quarter, or this was an anticipated incremental revenue to be booked in fourth quarter which has not happened?
It was an anticipated revenue to be booked in Q4, nothing of the past quarter.
Okay. And this won't reoccur in the coming quarters, right?
No.
It's cancelled.
Yes.
No?
Yeah. And Vinit, last thing, we are exiting with a EBIT margin of 14.7. The full year margin is 15.7. The first quarter, we may have a headwind coming through visa, and second quarter, if we give a wage hike, it will have a impact on the margin. So earlier commentary about outlook to improve margin on a YOY, don't you believe it's a difficult task, or we are expecting some tailwinds to emerge in the second half? And all the best, Vinit, and congratulations, Vipul.
Thank you. See, again, some of these costs, what we are talking about, visa, etc., are all planned cost. So there is no surprise on that. In our planning exercise, that has all been factored in. As I said, the most important factor the two important factors that will play out in Q1, some of these one-offs that we called out are not going to be there. And then the growth is the other aspect which will sort of help us in terms of mitigating some of these headwinds. All that, as far as growth comes in, all these will be taken care of.
Okay. Thanks and all the best.
Thank you.
Thank you. The next question is from the line of Apurva Prasad from HDFC Securities. Please go ahead.
Yeah, thanks for taking my question. So we did mention this in the call of the change in the nature of deals that led to the disconnect between bookings and revenue growth. So my question really is that do you think the current levels of book-to-bill is adequate to accelerate growth, or in your opinion, booking velocity needs to go up and improve from here?
Yeah. So I think this is the combination that we should look at is the book-to-bill, as I said, on a yearly basis, where firstly, the order intake is up 16%. Even the book-to-bill is a healthy 16-17% above our quarterly revenue run rate. So I think that way we're fine. The important thing is that what you should look at is how we've grown all the pyramid. We've gone every bucket of the pyramid or every layer of the pyramid, we've added clients as well as grown across them. And I think that's what gives us that confidence, as DC has also been saying, about broad-based growth across verticals, across client buckets.
Yeah, just wanted to clarify on this point. So what you're essentially indicating is that if the book-to-bill remains at these levels, you could potentially accelerate from the 4% growth rate.
Potentially, but a lot of it depends on market conditions. So it is still a cautious environment out there. The only thing is, as I said, we've built up a good order book, which is why which we have confidence, which we know will flow into FY25 revenues. Yeah, thereafter, as the market conditions improve and if there is a return to discretionary spending, as we mentioned in our opening remarks, we will start to see an uptick.
Got it. And just finally on margins, is margin expansion for the year premised on growth acceleration, or you do see that happening irrespective?
Well, I think, this is DC here. See, margin is not a one-quarter phenomenon. I think if you talk about margin expansion, it has to be a discipline that you need to have within the organization, and we have done that in the past. And we would have done that in FY23 as well, but it is also dependent on how the revenue line comes in. The reason why we, changed the course, because if you only focus on margin, then obviously the top line also gets impacted. So we wanted to just take a pause. We still have the program which is running as far as the margin program is concerned, driven right from the top. I am personally monitoring that program. So margin is, it has to be part of the hygiene. It has to be part of the discipline. It is just that given the current circumstances, we feel that whatever we had planned last year, that did not, materialize. But that does not mean that we are going away from the overall game plan that we had. So if all goes fine, then you will actually see a little, slow, gradual uptick in terms of margin as we go along in this year as well.
Got it. Thank you.
Thank you. The next question is from the line of Sudhir Guntupalle from Kotak Mahindra AMC. Please go ahead.
Yeah. Hi, DC. This is just a clarification on your earlier point that the leadership and sales attrition is just business as usual. So are you implying or sort of confirming that these exits are not costing us any growth? Because if macro and let's say the discretionary spends where they are, if you look at it as a lowest common denominator for all companies, still a company of our size should have grown few percentage points higher than what we have delivered this year. So is there a need to acknowledge that this attrition is costing us, sales attrition, leadership attrition is costing us, and this needs to be fixed immediately?
Well, the short answer is absolutely no, because as I said, when we did the integration and past the integration, whatever happens as of first week of April last year, we are pretty much done with the integration. So whatever has happened is all part of the BAU. And the good news is that we had enough leadership bandwidth on both the erstwhile organizations, which is now combined together. So I can assure you that whatever we see in terms of the organization, in FY24, it is more the macro and the overall scenario that we have seen, but it has got nothing to do with the leadership attrition. And whatever we talk about attrition as we go forward, it's part of BAU, which is absolutely normal.
Okay. Thanks, DC, and congrats and all the best on it. That's it from my side.
Thank you. The next question is from the line of Ashwin Mehta from Ambit Capital Private Limited. Please go ahead.
Hi. Thanks for the opportunity. Two questions. So DC, as we look to chase growth, do we need to relax some of our operating parameters? Like we run at almost the highest offshore effort at around 85%. Our SG&A levels are more like 12.5%, which is towards your historical low. So do you need to invest here? And thirdly, in terms of utilizations, do we need to take them down? And the second question is around the right of use assets. What has driven the more than 40% sequential increase in terms of the right of use assets?
The second one you answered. So as far as the chasing growth is concerned, look, I mean, utilization where it is right now, I think Nachiket alluded to it. Our healthy utilization range is 85 to 86% in that range, and even and as we get on with growth, we are always willing to get the hiring engine pumped up, and at this point of time, it is not a difficult situation for us to ramp up faster if we need to. So given all these conditions, all these criteria, I don't think there is any problem from our perspective in terms of the overall operating model, which will help us to chase growth. And, there are, and also when you talk about if you look at FY24, when we talked about that we want to just slow down on the margin goals, the idea was exactly what you're talking about. Idea was that let's look at what we have, and we don't want to take margin up just like that unless we also can grow the top line. So we are now ready in a situation where we are confident about the growth, and even if you have to accelerate growth, if the discretionary comes back, we should be able to do that in the current scheme of things. Nachiket, you want to add anything?
And in terms of the offshore on-site efforts, you asked, we don't target a particular number. It's not a sort of a margin lever for us. It's a reflection of the nature of the work and the kind of deals that we have with the customers. So it's not that we are targeting a particular number there.
And your second question on the right to use, it's basically it's related to the capex question which was asked earlier. It is basically a capitalization of the two leased properties that we have recently got into our portfolio, and that's the reason of that jump.
Okay. And just a follow-up to what Nachiket mentioned. So in terms of our deal pipeline, which is skewed towards more cost takeout kind of deals, is there more people or asset takeover involved in terms of deals versus what we would have done in the past?
So, not all deals have that asset takeover or people takeover component. Some deals do. So we continue to be cautious about the kind of deals that we want to get in from a longer term perspective, and the margin impact of that and so on and so forth. So there is that our strategy remains same that it was in the past as well. And as far as the offshore effort part is concerned, I think that is a reflection of the type of deals that we are talking about. Typically, multi-year, long-term cost takeout deals tend to have higher offshore leverage as well. Hence, you see the effort mix in the way you see it.
Okay. Thanks a lot and all the best.
Thank you. The next question is from the line of Apurva Prasad from HDFC Securities. Please go ahead.
Thanks for the follow-up. So on BFSI, the two deals that were mentioned, is that restricted to the top account, or is it beyond that?
Okay. So it is beyond that.
All right.
I think, folks, please look at it as two isolated projects which were closed within the quarter, and there is no impact going forward for it. We're going back to, the answer that I gave you regarding the order intake that we already have in BFSI, the wins that we have, and the pipeline that we have. And, that gives us the confidence of how we see it returning to growth in Q1.
Sure. Thanks.
Thank you. Ladies and gentlemen, that was the last question. On behalf of LTIMindtree, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.